Will investing in the Tata AIA systematic investment plan provide you with the opportunity to build wealth in the long run? Let us find out through an in-depth analysis in this video. So hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. So this is an unit linked individual life insurance savings plan. So some of the key features of the policy are there are no fees for the allocation of premiums or policy administration, and you get to enjoy extra allocation of units with a return of mortality charges, and there are wealth boosters which will enhance your fund value. Extra allocation in the first year premiums is available for female lives, and wellness benefits with the vitality readers are also available. Partial withdrawals are allowed, which acts as a second source of income, and there are benefits like death benefit and maturity benefit which will differ based on the plan option you have opted for. And from the investment perspective, you get to choose from 28 investment fund options, and also you get to choose from two investment portfolio strategies which you can choose based on your risk profile and also your time horizon for the goals you have. So based on this, you can choose your investment strategy and the fund options you want to invest in. But also, as a unit link policy, there are various charges as well, like fund management charge, mortality charge, discontinuance charge. So all these charges are recurring charges, which mean, but still compared to other ULIP plans available in the market, this plan doesn't have premium redirection, premium allocation, all that kinds of charge, but still these charges are recurring. That means till the end of the policy term they will be deducting these charges from your premium amount, so it will definitely impact the returns in your overall return in the long term period. So some of the advantages are, as I have already mentioned, there are no premium allocation charge, policy administration, partial withdrawal charge, fund switching charge, or premium redirection charge like other ULIPs in the market. And this plan allows add-on riders. So there are 28 fund options and 2 investment strategies to choose from. A whole life option is also available. Premium waiver benefit is an inbuilt option under ISIP Young Genius plan. And there is no restriction in fund switching and premium redirection in a particular year. So these are some of the advantages. However, the disadvantages are a loan facility is not available. The lock-in period is 5 years for this policy, and during the settlement term, the policyholder bears the investment risk in the investment portfolio. So you need to consider all these drawbacks before deciding to invest in this policy. So now, as we have a basic idea about this policy, let us move on to the IRR analysis. So as we have already a basic idea, we are going to do the analysis part of the video. But still, if you want to know more about certain aspects of the policy in detail, you can definitely refer to the policy brochure. So now, to help us make a more informed decision, we are going to calculate the internal rate of return based on the benefit illustration given in the policy brochure. So for calculation purpose, let us assume that a 30-year-old male buys this policy for a sum assured of 10 lakhs. So the premium paying term is 10 years and the policy term is 30 years. Annual premium is 1 lakh for this policy. So if he pays a premium for 10 years, he would be receiving the fund value after 30 years. So in the cash flow depicted on the tabular column in the screen, you can see that the future investment returns are depicted based on 8% and 4% per annum respectively. So these are given in the policy brochure to help us understand how this policy can perform at both extremes, which is in the worst case scenario and in the best case scenario as well. These are not upper or lower limits guaranteed for you. This is the amount you will receive from maturity. These are just projected rate of return. They are not guaranteed returns because the value of your policy will be dependent on several factors including future investment performance. So the IRR for the 4% per annum, which is the worst case scenario, is calculated at 2.73%, and the IRR at 8% per annum is calculated at 6.65%. So at the end of 30 years, in the 4% scenario, the fund value would be 19.91 lakhs and the IRR is 2.73. At the end of 30 years, in the 8% scenario, the fund value would be 52.57 lakhs and the IRR works out to be 6.65%. So the Tata policy is a long-term investment product, which is it has a policy term of 30 years. But the IRR it has given, which ranges from 2 to 6%, is not sufficient to meet your long-term goals. Other market-linked product offers better returns when compared to the Tata policy. So that's why in the next segment of the video, we are going to do a comparative analysis including including market linked returns with other investment products. So we are going to take a alternative strategy here. So instead of investing in a combined policy like this where they combine both insurance and investment, we are going to invest in it separately using the same 1 lakh premium used for Tata policy. So for life cover purpose, we have opted for a pure term life insurance for a sum assured of 10 lakhs, which will only cost us an annual premium of 10,700 rupees. The policy term is 30 years and the premium paying term is 10 years, which is similar to the benefit illustration we saw from the Tata policy. So the balance amount would be 89,300 rupees, which can be invested as per our risk appetite. So here our investment choice are PPF and equity mutual fund, and you can choose any investment as per your risk profile and goal. So under PPF, we have taken both here because we want to show you how this can perform in a risk-free product and in a product which has risk. So under PPF, the 15-year minimum contribution is compulsory, but here the premium paying term is 10 years. So in the last 5 years, a minimum contribution of 500 rupees is made into the PPF account. And equity mutual fund redemptions are subjected to capital gains tax. Here the post-tax value is taken for IRR calculation. And if you want to know how we have calculated tax for the equity mutual fund, we do have a small tabular column presented on the screen for your easy reference, which you can pause and see. So the IRR for the combination of term insurance plus PPF is calculated at 6.64%, and the IRR for term insurance plus equity mutual fund is calculated at 10.99%. So here in this we can see, especially in equity mutual fund, the maturity value after tax itself is calculated at 1.49 crores, and in PPF the IRR is 6.64%, which is similar to the Tata policy's 8% scenario. But Tata is a market linked product where there is no guarantee for your return, but here PPF is a debt instrument and it's also entirely tax free. And the equity mutual fund IRR is something you can call as a inflation beating return, and it will help you in wealth accumulation in the long term period. So what is the final verdict then? Is investing in the Tata AIA ISIP plan worth it or not? So this policy provides a dual benefit of life insurance coverage and investment growth. So a portion of the premium paid goes towards providing life insurance protection, while the remaining amount is invested in the chosen investment funds. But it doesn't offer better risk adjusted return. The risk and return is proportionate under this plan. The return for any long term investment should comfortably beat inflation. Otherwise, it is difficult to meet the financial goals. Also, liquidity in the first years is a big question mark. All these factors makes it unattractive among its competitors. The life cover under this policy is also low when compared to pure term life insurance policies. A term plan offers higher coverage compared to this at an affordable premium as well. So like many policies in the bazaar, the insurance agents would push you to try this great new plan for their own high agent commission. Please beware.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.